were discussing in the last lectures about the depreciations. We have discussed that how depreciation is calculated. Then we discussed how it is recorded in the books of account. Then we have discussed that what is the difference between the market value and the net book value regarding the asset. So the same concept we will continue, but here our main focus is that if some asset is purchased, maybe for 5 years or 6 years, or the life is expected 10 years, but there is a possibility that we sell that asset, that non-current asset, before the useful life that ends. For example, if the life is 6 years, but we can sell it after 2 years, 3 years, 4 years. So now in that case, there is a possibility the company is getting some profit, company is getting some loss on that disposal or on sale. So how to treat that one? One more thing that is very important we will discuss today, that if there is any salvage value regarding the asset, how to treat that one in the depreciation. And again, we will start with the very basic depreciation method, that is the straight line depreciation method. In this example, see the very basic entry, the purchase of the fixed asset is there, that is the non-current asset, tangible assets. So we assume that the business has purchased one vehicle, because the life of that vehicle, that car, is how much? We assume as a 5 year, because it is more than 1 year, so it will be depreciated because it is a non-current asset, and then it's a tangible asset. And the business has purchased, or the company has purchased that asset on the cash basis, means they paid the immediately cash. So vehicle or the car is purchased for $25,000, and with the expected life or the useful life of 5 years on the cash basis. So this is the first entry. Let's say we record it on the 1st January 2020. So the car account or vehicle account is debit, and the cash account is credited with $25,000. Purchased car. So this is the first transaction on the 1st of the January. For the ease purposes, for the simplicity, we are assuming that it is purchased on the very first day of the year. Now, the next thing, the concept is the salvage value. Salvage value means what? That we assume that this car is purchased and it will be used for 5 years, but after 5 years, it has some market value. It has some value. I mean, it will not be just a zero value. It has some value. Like if you purchase like a building today, after 10 years, 20 years of the life, so it has some value. In the same way, the car is purchased, and we assume that after 5 years, when the life of the asset in the books will finish, the value will be how much? That is 5,000. So it is simply called as the salvage value, or the name may be the scrap value, or we can also call it as a residual value. Residual value, scrap value, or the salvage value is what? That is the market value. The market value of the asset, but at the end of the expected useful life. Means this car is purchased today for $25,000. It will be used for 5 years, but after 5 years, because it has some value, and we assume that it will be sold for how much? For $5,000 after 5 years. So because of the salvage value, our depreciation will also change. The amount, the depreciation amount, the expense amount for every year will change. So here again we are using the straight line method. So in the previous examples, we have simply used what? The cost of the asset divided by the useful life. So if it is 25,000, so divide by 5, so it will be 5,000. But now here we are assuming that it has some salvage value or scrap value or residual. Residual means the value at the end of the year, 5. So it is assumed that it will be how much? It will be $5,000. So it means $25,000 we are paying now, but 5,000 we will recover within the 5 years at the end when it will be sold. So it means that expense or the total amount of the company with the cost is there, so it is how much? It is almost 20,000. Then divided by 5, so it will be $4,000. So this is the depreciation per year. So here a formula is a little bit changed, that the cost of the asset $25,000 minus the assumed or expected salvage or scrap value, that after 5 years how much will be the total value, and then the life is 5 years. So 25,000 cost minus 5,000 salvage value divided by 5. So 4,000 per year it will be depreciated. Now in that case we will depreciate it, and again 31st December 2020 it will be depreciated for 1 whole year. So the depreciation amount we know that is how much? That is 4,000. So the depreciation expense will be debit forward for car or vehicle, and then accumulated depreciation again for the car will be credited with how much? That will be 4,000. So the duration will be depreciated or the depreciation for first year. So it is used for 1 whole year. So now it is 4,000 depreciated. So the value was 25,000 or 25,000 at the start of the year when it was purchased. Now it is 4,000 depreciated. So now its book value, which we can say is how much? 25 minus 4, almost $21,000. Now we assume that it is depreciated for 2 years and then it is sold. Means after 2 years that asset is sold, and it is sold for 16,000 cash. Now it means that the company or the business has used this vehicle, used this car for how many years? For 2 years, and after that it is sold, okay, for how much? For $16,000. So it will be depreciated for 2 years. So first year depreciation is over. So now we will record the depreciation for the second year, again 31st December 2021. So the depreciation expense, same entry, same amount, okay, and accumulated depreciation of the car will be credited by 4,000. So the entry will be there, and then the duration is same, depreciation for second year. So now the asset is depreciated for 2 years, the whole 2 years, and then the business is trying to replace the car, or they may be purchasing some other car, or it is as some issue. So that's why they want to sell it, and when they sold it, the value is how much they are getting is 16,000. So now we have to consider the sale of this fixed asset, the disposal of the car. So what we have to do, first of all, the very basic thing we have to do, we have to consider that how much is the net book value. And I hope you remember the formula for the net book value. It is what? That is the cost of the asset minus the total accumulated depreciation up to now. Now it is what? It is cost minus accumulated depreciation. And here in that case, accumulated depreciation for how many years? For 2 years. Okay. So the cost is how much? That is 25,000 minus accumulated depreciation is 4,000 multiplied by 2. So 8,000 is the total accumulated depreciation. So 25,000 minus 8,000. So the net book value of that asset is 17,000. So now after 2 years of the use, in the books of the account, the value of that asset is 17,000. But the business, when they have sold this asset, this car, what they are receiving only 16,000. So what does it mean? It means, is there any profit? Is there any gain on this selling, on this disposal, or there is any loss? So according to your books of account, according to the business books of account, the value of the asset is 17,000, but it is sold for how much? For 16,000. So the value, according to you, according to your books, is how much? 17,000. But sold for 16, meaning that there is a loss. How much loss? Almost 1,000. So what we will do, we will simply do like that how much to calculate the loss or the gain. So loss will be obviously in the bracket, sorry for that, or the gain. So it is simply the sale price minus the net book value. So the sale price is how much? That is 16,000. Net book value is 17,000. So the answer is minus 1,000. So it is negative. So it means this is the loss. So after 2 years of the use, the car is sold for 16,000. So 1,000 is the loss on the disposal of this asset. Now, what we have to do, we have to write that thing in the books of account. Let's say it is sold on 1st January 2022. So the whole 2 years it is used, and on the very next day, on the first day of the next financial year, it is sold. Okay. So we are assuming that it is not depreciated for that year. So for 2022, there is no depreciation. So how to record that thing that it is sold for 16,000? So total value was 25,000. Book value at that time is 17,000 after 2 years, but sold for how much? For 16,000. So it means there is a loss of 1,000. So here we have to record the sale transaction or disposal transaction. So we just first of all go for a little bit, you can say, the analysis of the transaction. The first thing, what is affected, what we are getting is the cash. The business is getting a cash from the sale. So it is very simple. The cash is an asset and it will be increasing. So that will be debit. So we write here like a simple one. The cash account, how much? That is 16,000. It is very simple thing, and the business is receiving a cash, so that will be debit. Now the next thing, if you see here, there is a real account of accumulated depreciation for year 1, accumulated depreciation for year 2. So both accounts have a balance of 4,000, or the total balance of how much? That is 8,000. But now if there is no asset, because now they are disposing of the asset, they are selling the asset, the car, so it means there should be no accumulated depreciation in your books of account. It should also be disposed of. So the balance of that account is how much? That is 8,000. So we have to write it off. We have to cancel that account. So accumulated depreciation for car. How much depreciation? That is $8,000 is the depreciation. So up to now it is depreciated for $8,000. So the account should also be disposed of. It should be cleared. The balance should be 0 in the accumulated depreciation account. So that is 8,000 is again debited. Then we have calculated that there is a loss of 1,000 on this transaction. Means the business is selling the car at the value that is lower than the book value. So it means there is a loss of how much? $1,000. So we write here like a loss on disposal. Okay. So how much is the loss? That is 1,000. So if you see here, we have 16,000 here, 8,000 and 1,000. So total is almost how much? That is 25,000. Now we have a debit side. There are three, you can see the accounts that are affected on the debit side: the cash account, accumulated depreciation account, and the loss on the disposal account. All are the debit. Now, because they are selling this asset, they are selling this car, but the car was in the books of account for how much? The vehicle account was 25,000, but now they are selling this car, so the balance in this account should also be zero. So when they purchase the car, so the vehicle account, the car account, they have debited, so the same account will be credited to write it off from the account. So we could write here like a vehicle account. Which account? That is a car account, and that will be credited with 25,000. So this is the complete entry on the disposal, or what we say, the sale of car after 2 years. So because the car is sold after 2 years, so what we have there, the cash account, but the cash we have received in the form of the hard cash or any bank account, so that will be debited. Then the accumulated depreciation, because we have to make the zero balance in the accumulated depreciation account, that is the real account. So the balance was 4,000 plus 4,000, so it was the 8,000 balance was there. So we have to clear that account, we have to make the balance zero, so it will be debited again for 8,000. Then there was a loss, but we calculated the loss is just like an expense, so that is debit. So it is debited with 1,000, so 16,000 here, 8,000 here, and 1,000 for the loss. So the total amount is 25,000. And now we have to write the vehicle account also on the credit side, because when it was purchased like a 2 years back, it was debit. Now the same account will be credited with 25,000. So now the debit side and the credit side is okay, both are equal. So it means that disposal is over. So now they have sold the car, they received the cash, the vehicle account is balance is zero, the accumulated depreciation balance is zero, the cash they have received is debited, and the loss which they incurred is also debited. So this is the final entry. So the cash account debit, accumulated depreciation account for the car is again debit, and then the loss is debit, and the vehicle account, the credit is there. So this is the concept, that how they are selling the fixed asset and what are the accounts that are affected. So cash, accumulated depreciation, disposal, and the vehicle account will be credited with 25,000. So the balance is nil. Okay. So there is other possibility that sometime they are selling the car, but that is more than or above the value of the book. Now we just assume it. For example, a small change we can make here, that let's say that it is sold for here 18,000, or it may be sold for, let's say, 20,000. So we just make a small change here, that how much it is sold and what will be the effect on this. Let's say we call it as a, like, if it is sold for how much? 26,000. Obviously the entry will be same, the purchase account, the depreciation account year 1, depreciation account year 2, it will be same. Only change will be what? Change will be in the transaction when they are selling the car. So this transaction will be changed. So now we just change that transaction. Now we are assuming that that asset or that car is sold for not 16,000. It is sold for how much? This is sold for the 26,000. So now how to get that account? What will be debited? What will be credited? So very simple thing. Depreciation same, asset purchase, depreciation for year 1, depreciation for year 2, so it will be same. So only change is that instead of 16,000 here, we have to just replace it with the 26,000. Now the fixed asset, the net book value is same, 25,000 minus 8,000, so it is 17,000. Again, there will be no change in that. Only change will be that here the sale price. So sale price here is not 16,000. So here it is how much? We are just replacing that with how much? With 26,000. The second thing that is very important, now we have to see either the balance is positive or negative. The balance is how much? The balance is 9,000. It means they are selling the car for the value which is above the book value. In the books, you are writing this car for 17,000, but you are selling it for 26,000. It means there is a gain on the sale. How much? 9,000. So you are selling the asset above the book value. How much above? 9,000. So this gain, because the answer here is positive, so that's why we will call it as a gain on the sale. The transaction will be almost same. Instead of the loss, we will just write the gain or the profit in. So now here the same thing, we will write the cash account. But the cash what we are receiving now is not 16. It is how much? It is 26,000 cash. So that will be debited 26,000. Now accumulated depreciation, we have to make the balance on the accumulated depreciation 8,000. So again that will be debited. Now two transactions are over. The next thing, because there is a gain, it is not a loss on the disposal, it is a gain on the disposal. So the gain is like a revenue, it is a benefit for the company or the profit for the company. So the gain is increasing, so it will be credited. So here we will write the gain on disposal. So how much? The gain 9,000. And the last thing, that is the same one, the vehicle account. Which vehicle? The car account was there, the same account which was debited there, here it is credited with 25,000. So sale of car after 2 years. So transaction is almost same, only difference is that instead of the loss, there is a gain on the disposal, and that gain is how much? That is 9,000, but we have calculated already here. So the cash account 26,000 the business has received, cash is debited. Accumulated depreciation for year 1, year 2, so the total is 8,000. So to write it off, to cancel from the accounts, to clear the account, make it zero balance, so it is debited by 8,000. Now the gain calculated 9,000 is credited because it's the benefit. And then the vehicle account, it was debited here, now it will be credited to make the gain. The balance in the vehicle account as a nil balance or zero balance, so it is credited. So we have a same 3 transactions, only difference will be instead of the loss of 1,000 or any other amount, we have a gain on this transaction of 9,000. So in this way, we will record the purchase of the fixed asset, then the depreciation for 1 year, 2 year, 3 year, or it depends that after how many years the asset is disposed of. And the last one, if it is disposed of, there's maybe a possibility that on the disposal you are getting some benefit, like there's a gain on the disposal, or there's a possibility there is a loss on the disposal. So loss or the gain, both will be calculated, and then it will be entered in the books of account in the debit and credit form. So I hope that there are some clearness according to the concept. If still there's a confusion, if you have any question, you can ask me in the comment. But this is the main thing, that how the asset is purchased, how it is depreciated, and if there is any sale of the asset, it may be on the gain or it may be on the loss, how it is treated. Thank you.